CEI. This is the particular stock it's related to. Five value stocks in the energy sector. Okay, based on PE ratio. All right. Number one, PE ratio is the price per earning, the price of the actual share that you're buying versus the earnings of the company in itself, potentially in some form of per share value, right? So I see a couple here, Gaslog, Adams, whatever, but then Camber Energy, CEI, all right? Look at this very, 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 very low value. So currently it's actually trading at about a $2 mark. It's kind of readjusting, testing for a support down below in the 190 area. So we're basically looking at this location and we're debating whether this is a good value for the stock. So let's check our price earnings ratio. Now, another case is that we actually have a huge boom in the energy sector lately, whether it's oil, gas, electric, or some other utility. There is some big movements in the energy sector, especially uranium. I believe it was ticker UUUU or something. 4Us, I don't recall. So here's where we decide. First, a low PE ratio is a good indication that the stock is undervalued. What does it mean to be undervalued? It basically means that the price of that stock does not match or is very under the earnings of that particular company. And in order for it to balance, a perfect PE ratio would be the value one, a price of a value that's equal to the earnings of that value. And this is kind of where fundamentals really play a big part. When you're thinking of fundamentals, you're trying to essentially attach a company to the earnings of a company. This is how a fundamental value comes up. After all the taxes, all the costs, basically whatever is left over is going to be the value that you would assume you'd be giving that particular company. And then you take the amount of shares based on the revenues of that company and no, I think it was no price. Price equals revenue minus cost, or R, no, aha, profit equals revenue minus cost. So really, the profit is the earnings. So when you take that profit divided by the number of shares, you get E. But we don't need to go so far into figuring out this PE ratio. Right now, the PE ratio is 0.05, which is really, really very low. This is a fundamental concept. So how do we figure out what a balanced PE ratio would be? Well, luckily, I have it sitting here. Okay, so let's imagine that I captured the price at 1 or 2-1. Let's call it even less. But when I did the math backwards, I got a dollar value of a price of $42 to catch up to the price earning ratio, price per um, PE ratio, price of the share per the earnings value, right? So in order to go backwards, we just construct this equation in a backwards notion. So here's what the equation would work as, because we're looking at a basic value of proportions. So in math class we go. So let's say we have that price P of 210, right? 2.10. This is a dot. This is a dot, a really bad dot, but it is a dot. Divided by the earnings, right? The earnings we're not necessarily sure on because we don't have that value, right? So we call it E. And we say that this is the given value of 0.05. So 0.05. So since we have a single variable, we can work backwards and figure this out. How do we do that? Well, first we do some arithmetic. First, we're going to take our E, multiply it to both sides. This has got to be one of those flashbacks or nightmares for some of you based on your your classes that you've had. So this cancels this, correct? Right? All right. So now we have this equation. We don't have an E in the bottom. The E is on the side. But we want to find the earnings quickly. So we're just going to divide both sides by the 0.05, do the opposite of what is attached to our variable. And that means we have to divide both sides by 0.05. And that's what this equation here represents. So if the earnings are 42, what is a healthy PE ratio? Well, in order for us to get a nice 1 out of the PE ratio, not only do we need a 42 at the bottom, which is our E, our earnings value, but we also need a 42 at the top, causing us to have a perfect price to earning ratio of 1, meaning it's balanced. So, what does this mean? This means that the actual share price should be around the $42 value. Where are we now? We are sub $2 fighting for a nice support. What does this mean? Well, this means that we're basically sitting on a very undervalued stock, especially with high demand for energy currently. And if we take 42 divided by 2, we have a 21 time multiple. Well, what does that mean? That means that if you put $100 into this stock right at this moment, which would cost you $188, you would be multiplying that by 21, giving you a return of $2,100 and further forward. Of course, you would have to subtract your ingoing costs, which would now be about 188. So you make about a not $1.88, 100 shares. So that's 188. So you'd make a profit of 1,912 based on your current entry point. And the current entry point seems to be even getting better and better and better. So this is a good dip buying opportunity based on fundamentals that are given from Benzinga. Now, these other ones that they have here, well, they're above 1, so they're kind of overvalued. This one especially, this one very much 8 times overvalued. So I wouldn't touch these others, but this outlier, which happens to be CEI Camber Energy, seems to be even more directly related to a fundamental growth in the company rather than just simply a squeeze play as we originally thought. This also means that companies love to push a price down and create fear on good companies so they can enter super cheap before they flood the market with buys, causing this price to be equal to the earnings, making it a solid 1, right? So this happens many times with good companies. You would see that fundamentally many companies do great, but the price goes down because these institutions put selling pressure, and people do not understand why it's going down. Therefore, they release and sell their shares, giving these corporations even a better entry price than before. This is a typical strategy by big money players that try to enter a good stock at a very, very cheap price. This is fundamental. This price to earnings ratio is a whole mathematical concept based on all the costs, all the taxes paid, subtract all those, find the earnings of a company, and then compare those earnings to the actual price on the stock market based on the number of shares. This price to earning ratio is a direct connection between fundamentals and a stock. So the fundamentals of a company and the stock price. This is really the only actual connection because a stock in the general sense doesn't really connect itself to a company. The company has no control over that stock value. They just watch that stock go up and down. They may have some actual shares on their own, and their incentive is to grow those shares so they have possible income later on. But other than that, a company has no real connection to the stock price on the market. There is no real connection other than the fundamental price earnings ratio that sets that foundation for the cost based on how well the company is doing. So that's it. That's really all I wanted to do. I wanted to show this because this is honestly a huge bombshell. If this was like just a 50-cent value, that wouldn't be so big of a deal. But this is a very, very, very oversold, undervalued stock right now. And I would say fundamentally, getting in at this point in time will be fantastic because again, we saw that the $42 value is what this price of the stock should be valued at a balanced price to earnings value. Now, another thing I want to throw in there is that I tried to find this PE ratio also in my trading view, But normally they have this value here as the price to earnings ratio. I don't see this. In fact, when I go to more financials, I don't see any financials. This could be a trading view issue. It may not be directly related to the stock, but rather the person that keeps up with this data set. So it's a missing data set on trading view. So I don't think this affects my perspective too much since it is official and talked about based on Benzinga. Benzinga is a trusty source for a lot of market concepts and fundamentals. So get in as soon as you can. This is a very, very good time to get in just for pure fundamental purposes. It's not even a risky short squeeze play. We're at a very low risk value, very low at $1.20 at a good support, and we're just hovering at the 190. When our actual reward, well, we just saw the value. The reward that we would expect would be high $42. And that is a long way up. So I'm not a financial advisor, not financial advice in any sense possible. But based on this article, which is by Benzinga, and they are very dependable when it comes to the analysis of companies, I would say we have a winner. Winner, winner, chicken dinner. That's it. That's all I wanted to chime in. It actually took more than 3 minutes. I can't stop. I can't stop talking. Honestly, I can't keep these that low. So 11 minutes. I hope you stuck through. Maybe you didn't have to. So this case scenario. Thanks for coming through. I just saw the message. Hi, Mr. Finland. So in this case, we're done. That's all I wanted to say. This is a essential goodbye and goodbye as in BUY and essential goodbye from me.